The screen is already shaking, not from volatility, from history. A silver price chart stretches backward, not 5 years, not 10, but 150. Peaks rise violently, collapses follow even harder. And somewhere inside that chaos, a pattern begins to form. Because silver doesn't fail randomly, it fails on schedule. Every time it rises fast enough to matter, something breaks. Rules change, liquidity disappears, and the market collapses under its own weight. Not because silver was wrong, but because silver was never allowed to be right. In January 2026, the market watched silver surge toward record territory, and then, within hours, plunged toward the mid-80s. Headlines blamed profit-taking. Analysts blamed macro conditions. Traders blamed volatility. But silver had done this before, many times. If silver has such deep industrial value, if it has survived thousands of years as money, why has it underperformed for more than a century? The answer doesn't begin on Wall Street. It begins in Washington. In 1873, the United States quietly passed a piece of legislation most people have never heard of, the Coinage Act of 1873. There were no riots, no emergency speeches, no headlines. But that single document ended something that had existed for centuries. Before 1873, money wasn't gold or silver. It was both, a bimetallic standard. Silver coins circulated freely in the hands of farmers, laborers, and merchants. Gold anchored international trade and settled debts between nations. Together, they formed the backbone of trust. Then, with the stroke of a pen, silver was removed. No longer legal tender for unlimited amounts, no longer money, gold remained. Silver was demoted, it didn't disappear, but it lost its protection. Gold became the currency of kings and central banks. Silver became a commodity. This was not an accident. It was a transfer of sovereignty. When silver was demonetized, power shifted from the scattered population, who held physical metal, to the centralized institutions that issued paper notes. It was the first step in a long war against tangible assets. That single change would define the next 150 years. Silver didn't fail. It was sentenced. Here's the paradox that confuses every modern investor. Silver is essential. It conducts electricity better than any metal in the periodic table. It reflects light more efficiently than gold. It is naturally antibacterial. It is irreplaceable in solar panels, high-end electronics, defense systems, and medical equipment. Without silver, the modern world goes dark. The Tomahawk missile doesn't fly. The electric vehicle doesn't start. The solar grid doesn't generate. Yet despite this existential importance, silver has spent most of modern history behaving like a forgotten asset. It is too volatile to be treated as safe money, yet it is too monetary to be treated as a simple industrial commodity like copper or iron. It is stuck between two worlds, and that identity crisis created something dangerous, a metal everyone needs, but no system is designed to protect. History doesn't erase value, it delays it, and markets don't remove imbalances, they store them. Consider the physical reality of the market today. For thousands of years, silver and gold were mined and stored. But in the last century, a divergence occurred. Gold is a metal of hoarding. Almost every ounce of gold ever mined in human history still exists today. It sits in the vaults of the Federal Reserve, the Bank of England, the People's Bank of China, or in jewelry boxes in India. It is guarded, it is recycled, it is permanent. Silver is different. Silver is a metal of consumption. Because it was demoted from money to industry, we stopped hoarding it and started using it. We turned it into tiny electrical contacts. We sprayed it onto mirrors. We embedded it into bandages. We soldered it into circuit boards. And because the amounts in each device are so small, it is rarely recycled. It ends up in landfills. It ends up in the ocean. It vanishes. We have taken a monetary asset that took millions of years to form in the Earth's crust, and we have scattered it into dust. In 1950, there were estimated to be 10 billion ounces of available silver above ground. Today, despite record mining production, identifiable stockpiles have plummeted. The world now consumes more silver each year than the mining industry can dig out of the ground. This structural deficit has persisted for years. The market has survived only by draining the legacy stockpiles left over from the era when silver was money. But those stockpiles are finite. We are burning the furniture to heat the house, and the furniture is running out. So, if the physical supply is disappearing and demand is breaking records, why isn't the price $500? Why does it struggle to hold $50? This brings us to the mechanism of the trap, the illusion of paper. In 1971, when Richard Nixon closed the gold window, the final link between currency and reality was severed. Money became infinite. Gold repriced to reflect this new reality. Real estate repriced. Stocks repriced. But silver was left behind. It continued trading, as if the old system still existed. That contradiction has never been resolved. Silver is priced using industrial logic inside a monetary world driven by debt expansion, and that mispricing accumulated year after year. But this suppression isn't magic. It is a mechanical process centered on the futures markets, specifically the COMEX in New York and the LBMA in London. Silver requires only 3 conditions to remain suppressed: no monetary status, heavy paper leverage, and a futures market allowed to grow far larger than physical supply. When those exist, price becomes perception, and perception becomes policy. This is where the average investor gets slaughtered. Most people believe that when they buy silver on a trading app or through an ETF, they are buying metal. They aren't. They are buying a claim, a promise, a derivative tied to the price of metal, but not the metal itself. The futures market was designed to allow farmers to hedge their crops, but in silver, it has become a casino where the house bets against the players. For every 1 ounce of physical silver sitting in a registered vault, there are often 200, 300, or even 500 paper ounces traded against it. This is called rehypothecation. It means the same ounce of silver has been sold to multiple people. The system works only as long as nobody asks for delivery. It relies on confidence. It relies on the assumption that investors want cash profits, not heavy bars of metal. If too many people stand for delivery at once, the system cannot comply. It would default, so the system must prevent that moment from ever arriving, not by banning buying, but by making holding impossible. Every silver bull market follows the same script. It is almost a ritual. The price begins to rise based on fundamentals. The industrial deficit tightens. Investors get excited. Volume pours in. The price spikes. Volatility increases. Open interest surges. And then, the invisible hand strikes. But it doesn't strike with selling. It strikes with rules. The exchange raises margin requirements. Margin is the down payment a trader must put up to hold a contract. When margin requirements are raised, traders are forced to post more capital immediately. If they cannot, their positions are liquidated automatically by the computer. They are forced to sell, not because they want to, but because they can no longer afford the table stakes. This selling triggers stops below the market. Those stops trigger more selling. It creates a cascade, a waterfall event. This flushes out the speculators, the tourists, the leverage, and who is waiting at the bottom to buy? The bullion banks, the entities that hold the short positions. They cover their shorts for a profit, and they scoop up the physical metal from the weak hands. This is not a conspiracy theory. It is a matter of legal record. In 1980, the Hunt brothers provided the ultimate lesson in this mechanic. Nelson Bunker Hunt and William Herbert Hunt were Texas oil tycoons who understood the fraud of fiat currency. They watched inflation tearing through the U.S. economy in the 1970s and decided they wanted no part of paper money. They began buying silver. But unlike the Wall Street speculators, the Hunts did something that terrified the establishment. They took delivery. They bought futures contracts, and when the contracts expired, they demanded the physical bars. They loaded them onto armored trucks. They flew them to Switzerland. They moved the metal out of the system. By January 1980, the price of silver had exploded from $6 to nearly $50. The Hunts and their partners controlled hundreds of millions of ounces. The short sellers on the COMEX were facing tens of billions of dollars in losses. The banking establishment was staring at insolvency. If the price went any higher, major Wall Street firms would have collapsed, so the rules were changed in the middle of the game. The exchange, under pressure from the Federal Reserve and the banks, implemented Silver Rule 7. It was a directive that effectively outlawed the purchase of new silver positions. You could sell, but you could not buy. This was known as liquidation only. Imagine going to a supermarket where the manager announces that you can return groceries for cash, but you are forbidden from buying food. What happens to the price of food in that store? It crashes. The price of silver free fell. The Hunts were margin called into bankruptcy. The banks were bailed out. The status quo was restored, and the lesson was burned into the psyche of the market. If you try to corner the physical market using leverage, the system will change the rules until you lose. Fast forward to 2011. The scenario repeated. The Federal Reserve was printing money via quantitative easing. Investors fled to safety. Silver climbed towards $50 again. It looked like a breakout was inevitable. The momentum was unstoppable. Until, in a span of 9 days, the CME Group raised margin requirements on silver 5 separate times. 5 times. It raised the cost of holding a position by 84%. The result? A 30% crash in price. The momentum was broken. The bull market was killed. And in 2026, the methodology changed, but the mechanism remained. Margins were recalculated dynamically as a percentage of total contract value, quietly increasing capital requirements as prices rose, creating a soft ceiling that no amount of buying pressure could break through. This is why the crash always comes first. The crash is not bearish, it is structural. Silver cannot move to extreme valuations while leveraged traders dominate ownership. They must be flushed. Ownership must transfer from leverage to capital, from speed to patience, from paper to physical. That transfer only happens through violence. When silver collapsed toward the mid-80s in January 2026, the headlines blamed sentiment. They blamed a strengthening dollar. They blamed weak manufacturing data. The timing told a different story. The sell-off occurred at peak leverage, record open interest, immediately following margin recalibration. It wasn't emotional, it was mechanical. But there is a difference between the price on the screen and the value of the metal, and during every silver crash, the same buyers appear. These buyers don't appear on CNBC. They don't write newsletters. They are the refiners, the industrial users, the Asian physical desks, the private vault operators, the entities that never chase price, but always buy liquidation. Why? Because crashes are the only moments when silver becomes available in size. If a tech company knows it needs 50 million ounces of silver for the next 5 years of production for their new solar technology, they cannot just buy it on a Tuesday afternoon. Buying that much would spike the price against themselves. So they wait. They wait for the paper market to crash. They wait for the speculators to panic. And then they step in and sweep the physical market clean. This creates a floor, a higher low. Once leverage is flushed, the market changes character. Volatility compresses. Futures volume thins. The price stops responding to bad news, and that silence is not stability, it's pressure. We are entering a phase of the market that has no historical precedent. We have the monetary dysfunction of the 1970s combined with the industrial scarcity of the 2020s. The world is transitioning to electrification. This is not a political statement. It is an infrastructure reality. Solar energy is becoming the dominant source of new power generation globally. A standard solar panel uses approximately 20 grams of silver. It cannot function without it. The electric vehicle industry uses nearly twice as much silver as the internal combustion engine industry. The rollout of 5G networks, the explosion of AI servers, the smart grid, all of these technologies are silver dependent. For the first time in history, the industrial demand for silver is becoming inelastic. What does inelastic mean? It means the price doesn't matter to the buyer. If you are Apple and you need a tiny amount of silver to make an iPhone that sells for around $200, you will buy that silver whether it costs $30 an ounce or $300 an ounce. The cost of the silver is negligible compared to the cost of the final product. But if you don't have the silver, you have zero product, you have zero revenue. So the industrial users will pay any price. On the other side, you have the monetary demand, the investors, the people who see their currency losing purchasing power and want to exit the fiat system. When these two forces collide, inelastic industrial demand meeting fleeing monetary capital, in a market with a structural deficit, the result is explosive. But the paper market, the COMEX, still sets the price, for now. The question is, how long can the tail wag the dog? How long can a paper derivative dictate the price of a scarce physical asset? The answer lies in inventory. The market has survived this long only by draining the stockpiles. The LBMA vaults in London have seen their silver holdings hemorrhage. The COMEX registered category, the silver that is actually available for delivery, has hit historic lows. We are approaching a mathematical limit. You can print infinite dollars. You can print infinite futures contracts. You cannot print silver. If inventories fall to critical levels, the price must rise to incentivize new supply. But mines take 10 years to come online. You cannot flip a switch and get more silver. The supply is inelastic in the short term. So if supply cannot respond, price is the only variable left. But if price rises too fast, leverage enters. And when leverage enters, the banks smash the price to protect their short positions. This is the cycle. This is the prison. That's why silver never trends smoothly. It stair steps, collapse, base, reprice, collapse, base, reprice. It is a war of attrition between the physical reality and the paper fantasy. For over a century, one ratio has measured this imbalance, the gold to silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. Geologically, in the Earth's crust, the ratio is about 19 to 1. For every 1 ounce of gold, we find 19 ounces of silver. Historically, for thousands of years, the price ratio was 15 to 1. But in the modern era of manipulation, that ratio has been blown out. At moments of maximum monetary stress, when the manipulation breaks, that ratio compresses violently. In 1919, after World War I, it returned to 15 to 1. In 1980, during the Hunt brothers spike, it hit 17 to 1. In 2011, it compressed to 32 to 1. In 2026, it remains historically elevated, hovering near 80 or 90 to 1. This means silver is not just cheap, it is not just undervalued, it is mathematically broken. So where does the idea of $1,000 silver come from? Is it clickbait? Is it fantasy? No, it is arithmetic. If gold does what it is designed to do, which is to reprice the devaluation of fiat currency, and reaches $10,000 or $15,000 an ounce in the coming decade, which is a conservative estimate if you adjust for the expansion of the M2 money supply, and if silver merely returns to its historical average ratio of 15 to 1, do the math. $15,000 gold divided by 15 equals $1,000 silver. This is not a prediction of a bubble. It is a calculation of reversion to the mean. It is what happens when the artificial suppression fails, but this outcome is conditional. Silver does not reach extreme prices because analysts say so. It happens only if monetary confidence fractures, physical deficits persist, leverage remains purged, and ratio compression accelerates. If those conditions fail, the scenario fails. But if they align, price discovery will not ask permission. Markets do not move toward fair value gradually. They overshoot. They explode. The crash had to happen first. A parabolic move cannot begin while leverage dominates ownership. The crash is the transfer mechanism. It moves the asset from the weak hands who rent it to the strong hands who own it. Painful, necessary, predictable. For 150 years, silver lived under a verdict, demonetized, under-owned, consumed instead of stored. But systems do not remain stable forever. Entropy is the only constant. And when monetary architecture begins to strain, assets once dismissed become essential again. Silver does not rise when optimism peaks. It rises when trust collapses. It does not move when everyone agrees. It moves when certainty breaks. The paper market can suppress the price, but it cannot create the metal. Eventually, the physical reality asserts itself. It happened in palladium, it happened in rhodium, it happened in nickel, and it will happen in silver. The window is closing. The transfer is happening now, disguised as a crash, hidden behind volatility. The question is not whether silver can reach $1,000. That is simply a question of how much purchasing power the dollar loses. The real question, the only question that matters for you and your family, is who will still be standing when the repricing begins? Every time it rises fast enough to matter, something breaks. Rules change, liquidity disappears, and the market collapses under its own weight.